A Dividend Aristocrat is a company in the S&P 500 index that has increased its dividend payment for at least 25 consecutive years. Their impressive track record of growth makes them some of the most attractive dividend stocks to own. So much so that there is an entire ETF under the ticker symbol NOBL that tracks the S&P 500 Dividend Aristocrats. In this video, I'm going to analyze all 65 of the Dividend Aristocrat stocks. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout this breakdown, I'll be using my stock research tool, dividenddata.com, which is specifically designed to help analyze dividend stocks. On this tool, you get access to a stock screener. You get a dividend screener with a snapshot of every notable metric you need to analyze the dividend of a company. On top of that, you get curated lists of different dividend stocks to choose from. The Dividend Aristocrats are one of those lists, which can be a great foundation to start looking from. If you want access to the dividenddata.com research tool, we're running an exclusive sale right now. This will only last for a limited time, but you can get 50% off both the monthly and annual plan of dividenddata.com. So that's 50% off the already $100 discounted annual plan. And this is lifetime pricing, by the way, so you lock it in for life. To redeem the offer, enter the promo code SUMMER. This will give you the 50% discount for life. The first 100 people who sign up for the annual plan will be entered into a randomized giveaway to get free dividenddata.com merch. That is things such as this Buffett Munger 24 sweatshirt, our Make Dividends Great Again hat, and other lovely options. So again, enter the promo code SUMMER at checkout to get 50% off dividenddata.com. On this tool, you also get live access to my watch list and long-term dividend growth stock portfolio, which I frequently show on the channel. This is live access with my latest buys as they happen. If you want to sign up, link in the description and pinned comment. But let's get to the main topic of the video. All right, now I'm going to briefly analyze all 65 Dividend Aristocrat stocks. Let me know if you want a deeper video on any combination of the Dividend Aristocrats. That could be the 10 best, according to my opinion, the ones with the highest dividend growth rate, the highest dividend yield, really any metric. I'm planning to build a screener in the next week that will allow you to filter by those metrics on these different dividend stocks. So this might be my video next week. Comment below which one you think is the most interesting. Let's start with C.H. Robinson Worldwide, ticker symbol CHRW. This is a quarterly dividend payer with a long history of dividend growth. The forward-looking annual dividend payment is $2.44, which at the current stock price, that's a 2.78% dividend yield. The next payment is expected to be paid on July 1st. Now, what's interesting here from a dividend perspective is they actually have not increased since January 2023. The Dividend Aristocrats ideally increase every single year on a set pattern, but sometimes stocks will start to break these patterns, and that can often be a warning sign within the business that maybe they won't be able to sustain this level of growth. So the most recent increase was 10.91%. The 10-year compound annual growth rate of the dividend is 5.71%. The 2023 payout ratio was 45% based on free cash flow. And if we look at that based on net income for that year, it was 89%. But in the prior year, it was 30%. So we have a lot of fluctuation in net income. And if we dive into the stock here, we can get the full analysis of the business to give us a better look. And since I'm going to be covering all 65 in this video, I'm not going to be doing a full stock analysis on each one. So you'll be getting more of like my initial thoughts. Some of these I've thought about a lot in the past from prior analysis, but companies like C.H. Robinson Worldwide, I'm not as familiar with. But on the surface level, you can see that earnings have been declining really since 2022, which is not a good sign for long-term growth. So my initial thoughts are there may be much better opportunities available on the list. So again, we're going to be jumping between the stock screener and dividend screener here. Next up, we have NextEra Energy, ticker symbol NEE. Now this is an interesting one because in terms of dividends, it has been growing like crazy. It's a quarterly payment. Current yield is 2.69%. The dividend is growing at an 11% 10-year compound annual growth rate. They just had a 10.16% increase, so it's 10% year by year like that. So in terms of growth, this seems to be an awesome one. However, it does get a little more complicated. The payout ratio based on free cash flow has never been sustainable since 2017, and I'll dive a little bit into why that is. The payout ratio based on net income is still high, but in the most recent year was 51%. So as you can see, the stock price has soared in the past year after it crashed. Non-GAAP earnings per share has continued to grow year after year, but this is kind of an interesting business in that their free cash flow tends to be pretty poor over time. It does not sustain the dividend payment and is often highly negative. A good trend, though, is that from Q2 2023 through Q1 2024, they have had positive free cash flow. If this trend continues, then that's going to be a great improvement. And historically, the reason why this is that they spend massive amounts of money in capital expenditures. And although they've been able to grow their cash from operations significantly over time, the capital expenditures typically exceed that every year. However, it seems like that trend may be starting to change. They've also been funding that with large amounts of debt, as since 2016, they've gone from $30 billion in net debt to now over $73 billion in net debt. So I've been staying away from this one, and I did do a full stock review video, which you should probably check out. But in my opinion, most of this dividend growth has been unsustainable and fueled by debt. However, it's not all bad because they are growing cash from operations, which should be the core metric, the amount of cash the business is generating. But if they continue to increase their spending, then the only way they can pay this dividend is with debt. Next up, we have Air Products and Chemicals, ticker symbol APD. This is a quarterly dividend payer, currently trading at a 2.62% dividend yield. Dividend growth is slowing dramatically right now, down to 1.14% in the last year. This is coming off of a 10-year compound annual growth rate of 9.53%. And the reason this is slowing down is you can see the payout ratio based on free cash flow has been unsustainable for a number of years. And like I was worried about with NEE, this is coming home to roost with APD. And if we look at their full stock, you can see non-GAAP earnings per share continue to grow at a slow but consistent rate. And the stock price has dipped from its 2022 high. But I do have a similar concern to NEE, where they're growing cash from operations at a pretty good rate over the past couple years, but capital expenditures have soared massively. In this most recent year, they generated $3.2 billion in cash, but they spent $4.6 billion in capex. So their free cash flow is negative $1.4 billion. And free cash flow, in my opinion, is the most important metric to focus on when investing. This is all the cash left over after everything that the business can then redistribute to investors through dividends, share repurchases, or they can reinvest that money back into the business and do acquisitions, etc. So fourth, we have Albemarle. I think that's how you say it, ticker symbol ALB. Now, this dividend growth is terrible on this stock. At a 1.35% dividend yield, the 5-year compound annual growth rate of the dividend is only 1.71%. 10-year CAGR is 3.82%. On top of this, the free cash flow based payout ratio is not good. And the only interesting thing about this stock is that their earnings surged in 2023, and they have since completely collapsed. And this is a similar pattern to the stock price. So this one is a no for me. Next, we have Amcor, ticker symbol AMCR. And this one doesn't appear to have the same growth over time. It's an international stock, so the currency adjustments, I think, are causing why it doesn't seem like that. The 3-year compound annual growth rate of the dividend is 2%. 5-year CAGR is 1.16%. Current dividend yield is 4.92%. Payout ratio is sustainable but high. And I see no reason why I would even want to own this stock. Flat growth across the board. And this is the interesting thing about the Dividend Aristocrats. Some of them are terrible. They're super slow growth and no reason why I would want to own it. But then other ones, there's fantastic businesses in the list. And some that I do own in my portfolio. So next up, we have Walmart, ticker symbol WMT. And what's interesting here about Walmart is that they basically just had nearly a decade of extremely slow growth, but their most recent increase was 9.21%. So their 10-year compound annual growth rate of the dividend is 2.63%. The current yield is 1.24%. The payout ratio is sustainable at around 40% of free cash flow and 40% of net income. And with Walmart here, we do have a very high quality business. The only concerns I have is really over growth. I do think there are much better options in terms of long-term growth. Next, we have Brown & Brown, ticker symbol BRO. Bro. So this one's interesting. The dividend growth rate's pretty high. We have a 10% 10-year compound annual growth rate. Their most recent increase was 13%. It's a quarterly payer. Their dividend yield is 0.58%. So this is a low yield dividend aristocrat. Low yield, high growth. Their payout ratio is extremely low at 14%. So that's great. That's sustainable. And if we look at the stock performance over time, the earnings per share continue to grow at a very high rate, and stock price has followed suit. I might actually add this to my own watch list. Next, we have Essex Property Trust, ticker symbol ESS. The current dividend yield is 3.65%. The 10-year compound annual growth rate of the dividend is 6.54%. The most recent increase was 6%. The payout ratio based on free cash flow is 70%, and this is pretty stable. Earnings, though, appear to be a little less stable with high variability, and the stock price is definitely down from its recent high. The 30 PE ratio is not necessarily cheap. This is a real estate REIT, so keep in mind that dividends will not be taxed at the lower qualified dividend rate. So next we have Dover, ticker symbol DOV, and this company has an extremely long history of dividend growth. It's one of the longest tenured dividend aristocrats. The 10-year compound annual growth rate of the dividend is 5.35%. However, growth has slowed down significantly, with the 5-year CAGR only being 1.22%. At the current stock price, the dividend yield is 1.15%. The payout ratio is very sustainable, though, at 25% of free cash flow and 26% of net income. And you do see earnings growth over the past decade. The stock price is actually close to its all-time high. So this is a higher quality business than some of the other ones, but in my opinion, the slow growth rates exclude it from being in my portfolio. All right, so next we have Ecolab, ticker symbol ECL. This dividend looks pretty good. The 10-year compound annual growth rate of the dividend is 7.56%. The dividend yield is 0.95%, so this is in the low yield category. The payout ratio based on free cash flow is 37%. 44% based on net income. If we look at the full stock, you can see that there is a major dip in stock price, and that is followed by a dip in earnings over the past couple years. It's starting to recover from that, but on the surface level, this doesn't really seem that appealing. All right, at number 11, we have S&P Global, ticker symbol SPGI. Now this is a pretty good one. We're getting into a couple good ones from what I see in the next couple. All right, so S&P Global, it's a quarterly payer. Current yield is 0.84%, so it's a low yield. The dividend growth rate, though, is historically pretty high. It's an 11.74% 10-year compound annual growth rate. Now, a little concerning is the most recent increase was only 1.11%. Not great. And it seems like they paid a special dividend in the past, which is that one. Payout ratio based on free cash flow is 32%, which is pretty sustainable. That's good. 43% based on net income. So it seems like we had a little bit of an earnings dip since 2021, but the latest earnings report showed the highest ever. So perhaps we're going to get increased dividend growth in the next year. And overall, SPGI has a pretty good long-term growth story. So I do like the stock a lot better than other dividend aristocrats. And I think I have it on my watch list. Never mind, I just saved it to my watch list. At 12, we have Chubb Limited, ticker symbol CB. This is actually the newest addition to Warren Buffett's portfolio at Berkshire Hathaway. Their most recent dividend increase was 5.81%, just announced. 10-year compound annual growth rate of the dividend is 3.75%. Current yield is 1.38%, so it's a low yielder. Payout ratio, though, is extremely low at 10% based on free cash flow, 15% based on net income. And this is an insurance business, which is in Warren Buffett's circle of competence. He's very good at analyzing insurance companies. Earnings do seem to be growing, and it is trading at a low valuation of an 11 PE, even after this surge in stock price. The free cash flow growth is very strong at Chubb, and its valuation makes it a pretty good value stock in my opinion, but I don't know if I would consider it to be a good dividend growth company from that focus. Stock number 13 is T. Rowe Price Group, ticker symbol TRO. And from a dividend, I really like this company. The current yield is 4.27%. I think it's probably still a good buy to pick up. 10-year compound annual growth rate of the dividend is 10.92%. This has slowed down in recent years, with the most recent two increases being only 1% each. And a reason for that is a dip in earnings since 2022. We'll discuss that a little bit later. They also pay large special dividends, which is pretty interesting and I like. Payout ratio based on free cash flow is usually low at around 50%. The most recent payout ratio based on net income is 62%. And this stock, in my opinion, got pretty overvalued in 2021 because they had this massive rally in earnings. However, since 2022, their performance has been poor. Following their earnings drop, the stock price has reacted a little more negatively than the earnings. The earnings are starting to recover and the stock price really hasn't followed as much. So it leaves the company a pretty good long-term valuation in my opinion. Stock number 13, Pentair PLC, ticker symbol PNR. And again, anytime you see PLC, it's a foreign stock on this exchange. So I assume there's currency adjustments here, which is why it does not seem as consistent in terms of dividend growth. 5-year compound annual growth rate of the dividend is 5%. Current yield is 1.17%, so it's a low yielder. Payout ratio based on free cash flow is 26%. So that's pretty good, but earnings per share seem to be pretty flat over time. Stock price is at all-time highs. I'm really not interested in this one at all. Colgate-Palmolive Company, ticker symbol CL. Now, this is a high-quality consumer defensive company. I do like some of their brands and think they'll be around for a long time. Current yield is 2.13%. It's a quarterly payer. The big problem here is earnings and dividend growth. 10-year compound annual growth rate of the dividend is 3.34%. The most recent increase is 4.17%, which is a slight improvement. Payout ratio based on free cash flow is pretty good at 57%. That's 76% based on net income. And again, my big problem here is earnings growth. It's been mostly flat over the past couple of years, which makes it not something I would want to own in my portfolio personally. Next, we have Aflac, ticker symbol AFL. Now, this one is pretty interesting and worth adding to your portfolio potentially. 10-year compound annual growth rate of the dividend is 10.45%. The most recent increase is 19%, which was awesome. Payout ratio based on free cash flow is low at 30%, and that's 20% based on net income. And here you're getting pretty consistent earnings growth, which has been followed by stock price growth. So Aflac is definitely one you should add to your watch list. I already have it on mine, as you can see. Next, we have Expeditors International of Washington, ticker symbol EXPD. This one has had pretty good growth. It's a semi-annual dividend payment, so that means twice a year. Current dividend yield is 1.16%. The 10-year compound annual growth rate of the dividend is 8.6%, which is pretty good. This has slowed down with the most recent increase being 5.8%. Payout ratio is very low at 19%, which is sustainable. Payout ratio based on net income is 26%. Now, this is a freight and logistics company, so they had a massive earnings surge during the pandemic-related supply chain disruption, but its earnings have dropped off pretty sizably since then, so stock price has been stagnant. Now, here we have a good one. PepsiCo, ticker symbol PEP. Current dividend yield, 3.13%. It's a quarterly payer. Next payment is June 28th. The 10-year compound annual growth rate of the dividend is 7.54%. This is pretty consistent over time. The most recent increase is 7.11%. The payout ratio based on free cash flow is high at 84%, but in the sustainable range. It's 73% based on net income. And PepsiCo, like Coca-Cola, is a company where they pay out the majority of their cash flows as dividends because they are very mature and they don't have much room to reinvest into their own business. This is a very high quality consumer defensive business. They own some of the best snack and beverage brands in the world. I have in my portfolio, but I do tend to focus on higher growth stocks, so I haven't been adding much lately. Next, we have Emerson Electric, ticker symbol EMR. Current yield 1.98%, quarterly dividend payer, 10-year compound annual growth rate of the dividend is 2%. Most recent increase is 0.96. Dividend does not seem to be sustainable based on this past year with a 437% payout ratio based on free cash flow. However, it was around 50% in the years prior, so this may be an outlier. Payout ratio based on net income in the prior year was 9%, so we definitely got something financially going on that was interesting. Overall, though, this is an extremely slow growth company where I do not want it in my portfolio. I am staying away. Next, we have the Cintas Corporation, ticker symbol CTAS. Now, this is an interesting one. It's a low yield, 0.79% quarterly payer, and it seems like they transitioned from annual payments to quarterly in 2021. And long term, this is a high growth dividend, 21.64% over the 3-year compound annual growth rate. The most recent increase was 17.39%. It is sustainable, very low payout ratio, 35%. That's 33% based on net income. And this is actually one of the better Dividend Aristocrats, in my opinion. Look at this growth in stock price and earnings per share over the past decade. That happens for a reason. If I don't have it on my watch list, I'm going to add it already. So there we go. Next, we have Procter & Gamble, ticker symbol PG. This is one of, if not the highest quality consumer defensive company in the world. Current dividend yield is 2.39%. It is a quarterly dividend payer. Dividend growth rate over time, 4.57%, 10-year compound annual growth rate. This has accelerated with the 3-year CAGR being 8.38%. Most recent dividend increase was 6.99%. Payout ratio based on free cash flow was 65% and 61% based on net income. And again, my concern with Procter & Gamble and many of these other Dividend Aristocrats is slow growth. I frankly just think you can get higher total return in other places, but the dividend is extremely low risk and will be secure income for a long time to come. Next, we have General Dynamics, ticker symbol GD. This defense company has a 1.9% dividend yield. 10-year compound annual growth rate of the dividend is 8.64%. The most recent increase is 7.58%. Payout ratio based on free cash flow is 37%, 43% based on net income. Stock price performance has been good as of late, likely due to the wars, but earnings have been mostly flat with slight growth in recent years. Now we have the Coca-Cola Company, ticker symbol KO. This is one of Warren Buffett's favorite investments. Current dividend yield is 3.02%. The 10-year compound annual growth rate of the dividend is 4.75%. The most recent increase was 5.43%. Payout ratio based on free cash flow is 81%. That's 74% based on net income. And this is one of those companies where they pay out the overwhelming majority of their cash flows as dividends. Coca-Cola, although it's an extremely high quality business with a wide economic moat, its growth is just not significant at this stage. So it's hard for me to argue buying it right now over many other companies. That said, this is a secure dividend payment that if you already own it, this will power your retirement. Consolidated Edison, ticker symbol ED. This is an electric utility with a current dividend yield of 3.61%. It's a quarterly payer. 10-year compound annual growth rate is 2.8%. Most recent increase was 2.47%. And most of these utilities, you'll find that their free cash flow based payout ratio is terrible over time. Never sustainable. Based on net income, payout ratio is 43% in the prior year. And will I ever buy this? Absolutely not. The growth is just terrible over time. No chance this is making my dividend growth portfolio. Next, we have Medtronic, ticker symbol MDT. And here we have a 3.4% starting dividend yield, which is pretty good. Quarterly dividend payer, 9.6% 10-year compound annual growth rate. This has slowed down, though, with the most recent increase only being 1.45%. Payout ratio based on free cash flow is 70%, and that's 99% based on net income. So we're starting to get up there. That's multiple years. Stock price performance has been very poor over the past couple of years, and they really have been flat since the pandemic in terms of earnings, including that dip there. So we're coming up to some better ones here. We have WW Grainger, ticker symbol GWW. Current dividend yield, 0.93%. 10-year compound annual growth rate of the dividend is 6.62%. The most recent increase is 10.22%. The payout ratio based on free cash flow is 24.72%. That's 21% based on net income. So this is a very low payout ratio. And stock price performance has been very good here, and it's mostly fueled by their earnings growth over the past decade, especially this recent surge since 2020. So this is a higher quality one to add to your list. Next, we have Roper Technologies, ticker symbol ROP. This is a low yield one, 0.55% quarterly payer, but the dividend growth is very high, 14.13% 10-year compound annual growth rate. The most recent increase was 9.89%. Payout ratio based on free cash flow is 15% with a 20% net income payout ratio. Historically, this is always a low yield dividend stock, and stock price performance has been very good, and this is fueled by earnings growth over time. So this seems like an interesting one to dive deeper into. And here we have a stock that I actually own in my portfolio, and I'm planning to add more to over time. Automatic Data Processing, ticker symbol ADP. Here you can see the long history of dividend growth. Current dividend yield is 2.26%. So it's not high yield, but it's not low yield either. It's a really solid dividend yield. The 10-year compound annual growth rate of the dividend is 12.76%, and the most recent increase is 12%. So this is a decent starting dividend yield with high dividend growth, which I like. The payout ratio is sustainable at a 52% free cash flow based payout ratio and 55% based on net income. And this has mostly become a SaaS company at this point, even though it's classified as an industrial. I did a full stock review on ADP, and it's pretty great. Earnings growth has been solid over time, followed by stock price growth. I'm planning to add more of this in my portfolio, so definitely add it to your watch list at least. Next, we have the Sherwin-Williams Company, ticker symbol SHW. Now, this is an interesting one. It's a low yield, 0.94%. It's a quarterly payer. 10-year compound annual growth rate of the dividend is 14.58%. Their most recent increase was 18%, but that followed a 0.83% increase. Payout ratio based on free cash flow is 23% and 26% based on EPS or net income. And again, this is one of those higher growth ones with good stock price appreciation and earnings growth. So this is a watch list one if you don't have it on there. Next, we have PPG Industries, ticker symbol PPG, 1.99% dividend yield, 10-year compound annual growth rate of 6.85%. The most recent dividend increase was 4.84%. Payout ratio based on free cash flow is 32%, 47% based on net income. Earnings growth is pretty just flat over time, and stock price growth has been flat as well. Not interested in this one. Next, we have Hormel Foods, ticker symbol HRL. Current dividend yield is 3.66%. It's a quarterly payer. The 10-year compound annual growth rate of the dividend is 10.94%. However, that is not going to happen in the future, in my opinion. The most recent increase was 2.73%, and I think it will be in this low range moving forward. The payout ratio based on free cash flow has ballooned from 40% to 76% over the past 10 years. The payout ratio based on free cash flow has ballooned from 40% in 2016 to 76% now. Net income-based payout ratio is 74%. And the reason there's that increase in payout ratio and decrease in recent dividend growth rate is that earnings growth has been flat since 2016 pretty much. Yet they continued growing the dividend at an unsustainable rate, in my opinion, not adding Hormel to my portfolio. Next, we have Church & Dwight, ticker symbol CHD. Current dividend yield 1.05%. 10-year compound annual growth rate of the dividend is 6.23%. Most recent increase 4.13%. Payout ratio is pretty low, 33%. Based on free cash flow, which is really good. And net income-based payout ratio is 35%. Stock price growth has been pretty good over time, although since 2020, you haven't really gotten that much performance. And that's mostly because earnings haven't grown that much since 2020 either. But the long-term growth over a 20 or 30 period here with Church & Dwight is very solid. So this may be a great add in some portfolios, but I won't put it in mine. Next, we have Johnson & Johnson, ticker symbol JNJ. This is one of the classic Dividend Aristocrats. It's actually a dividend king too, so over 50 years of dividend increases. The dividend yield is 3.39%. It's a quarterly dividend payer. 10-year compound annual growth rate of the dividend is 6.51%. The most recent increase was 4.2%. Payout ratio based on free cash flow is 64%, and based on net income in the most recent year is 33%. And growth is slowing, but long term, it is a compounder over time. I don't own it in my portfolio, but if you're closer to retirement and you want that dividend yield with reliable growth, J&J is a very high quality company. Next, you have Nucor, ticker symbol NUE. This is a company with long-term, extremely slow growth, but they just recently started increasing their dividend. The most recent increase was 5.88%, and in 2021, they had a 23% increase. But other than that, the rate of growth has been just terrible over time. Current dividend yield is 1.32%, and the story of Nucor is really the inflation around steel prices. They've been just making a killing since 2021. Free cash flow based payout ratio has been 10% or under since 2021. So they have a lot of other cash they're not using as dividends. And here you can see this massive surge in earnings from commodity inflation. It is coming down though over time, and stock price is still up there in its higher range. So Nucor, I'm not playing this, but maybe you could trade it. I don't know. I don't feel good about it as a long-term hold, in my opinion. Next, we have Archer Daniels Midland, ticker symbol ADM. This is an agriculture company with a 3.27% dividend yield, quarterly dividend payer, 7.62% 10-year compound annual growth rate of the dividend. Most recent increase was 11%, which is pretty high. Annual payout ratio based on free cash flow is 32%. That's 28% based on net income, so we're in a pretty sustainable range. And earnings have fallen since 2023, and stock price has followed suit there, but long-term, this might be a buying opportunity depending on your outlook of the company. And that lowered price has increased the yield to 3.27%, so this could be a buying opportunity if you like the stock. Next, we have Lind, ticker symbol LIN. Current dividend yield, 1.28%. 10-year compound annual growth rate of the dividend is 7.9%. The most recent increase is 9%. Payout ratio based on free cash flow is 45%, and based on net income, 40%. Long-term stock price growth has been pretty good, actually very good, and earnings growth since 2020 has been really solid. So this could be an interesting one to add. Next, we have Fastenal Company, ticker symbol FAST, FAST. Current dividend yield is 2.44%, so that's a pretty good starting yield. 10-year compound annual growth rate of the dividend is 12%. Most recent increase in the past year was 11%, with a 8% increase and a 2.6% increase. Payout ratio, though, is high at 80% based on free cash flow and 88% based on net income. Long-term stock price growth has been pretty good, along with earnings growth, so this could be an interesting one to look at in your portfolio. Realty Income, ticker symbol O. This is one of the most popular real estate investments in the stock market. It is also one of the most popular dividend stocks. Current dividend yield is 5.81%, so this is one of the higher yielding Dividend Aristocrats. It is a monthly dividend payer, which is why people like it. It's called the Monthly Dividend Company. They actually have that trademarked. 10-year compound annual growth rate of the dividend is 4.06%, and over the past year, they've grown at 2.74%. And this is one of those companies where they increase it multiple times a year, which is interesting. Payout ratio based on free cash flow is 73%. And in a sustainable range long term, but based on net income, it's much higher at 242%, which is interesting. And if you're really focused on dividend income, then this would be a good option, although you will not be taxed at the lower qualified dividends rate because it's a REIT. I don't have this in my portfolio though, because the long-term growth is not high enough. There has been a stock price crash though over the past couple of years, so it could be a good buying opportunity long term if you're looking to buy O stock. And especially if you're close to retirement looking for that monthly dividend income, then this could be a very interesting option. Next, we have Becton Dickinson and Company, ticker symbol BDX. Dividend yield 1.58%. 10-year compound annual growth rate of the dividend is 5.98%. The most recent increase, 4.4%. It is sustainable based on their payout ratio, 52% free cash flow payout ratio, 75% net income. However, the problem here is slow earnings and price growth. Those usually follow one another. So this is not one I'm interested in my portfolio. Cincinnati Financial Corporation, ticker symbol CINF. Current dividend yield, 2.82%. It's a quarterly payer. 10-year compound annual growth rate of the dividend is 6.29%. The most recent increase was 8%, which is pretty good. Low payout ratio, 22% based on free cash flow and 24% based on net income. But long term, I don't have a good enough feel around their earnings growth. If earnings do not grow long term, this is not going to do well as a stock. Next, we have Kimberly-Clark Corporation, ticker symbol KMB. Now, you may remember I used to own this stock, and it is a high quality company, but it doesn't meet my growth standards. Current dividend yield 3.56%. It's a quarterly payer. 10-year compound annual growth rate of the dividend is 4.24%. Most recent increase was 3.39%. And the payout ratio is finally improving, at least in terms of free cash flow. It was 57% for the most recent year. It was up there in the 80 to 90% range though for a while. And the most recent net income payout ratio was 90%. And again, it's a high quality company, but growth is the problem. Their earnings are not growing at a high rate and stock price is going to be flat. So it's just not a good prospect for total return. Next, we have Chevron Corporation, ticker symbol CVX. I own a little bit of Chevron in my portfolio. Current dividend yield is 4.18%, although I have it at a much lower cost, so my yield on cost is closer to 8 or 9%. 10-year compound annual growth rate of the dividend is 4.3%. The most recent increase was 7.95%. So that's great growth for a higher yielder. Payout ratio is sustainable, especially during this boom oil cycle. 57% based on free cash flow in 2023. But with all oil companies, the story really comes down to this boom bust cycle in the price of oil. And during these boom cycles, they'll rake in cash. But then during the busts, like 2020, in 2016, they will lose money. So what Chevron, Exxon, and these other companies do is they build up their balance sheet so that they can continue paying a growing dividend throughout those boom bust cycles. So since 2021, Exxon and Chevron have been raking in cash. But they're not using all of that towards dividends. They're actually just making the business more sustainable long term. So Chevron's an interesting one to add, although I like to add during the bust cycles when they're cheaper. Next, we have Abbott Laboratories, ticker symbol ABT. Current yield 2.11%. 10-year compound annual growth rate of the dividend is 9.6%. The most recent increase, 7.84%. Payout ratio based on free cash flow is 70%. That's 62% based on net income. This is a medical devices company, so healthcare technology. And if anyone is wondering what happened in 2013 here, that was when AbbVie and Abbott Laboratories split. They used to be the same company. And I don't have enough confidence about their long-term earnings growth to add at this current price. Next, we have A.O. Smith Corporation, ticker symbol AOS. Current yield 1.58%, quarterly payer. 10-year compound annual growth rate of the dividend is pretty high, 15.61%. This has slowed down though, with the most recent increase being 6.67%. Payout ratio based on free cash flow is 30% and 32% based on net income. Long-term earnings growth has been pretty good. Stock price has largely followed. Next, we have McCormick & Company, ticker symbol MKC. This is a consumer defensive company. They have a 2.43% dividend yield. It's a quarterly payer. Good long-term growth, 8.54% 10-year compound annual growth rate. The most recent dividend increase was 7.69%. Free cash flow based payout ratio is 43% in 2023. That's 61% based on net income. Earnings growth does seem to have plateaued since about 2020 or 2019, and stock price has actually declined in that time. So that boosts the dividend yield to 2.43%. So from a dividend perspective, it might be interesting if you think earnings will reaccelerate into the future. Next, we have Caterpillar, ticker symbol CAT. Current dividend yield is 1.58%. That's a quarterly payer. Good long-term growth. 10-year compound annual growth rate is 8%. Most recent increase was 8.33%. Free cash flow based payout ratio in the most recent year was 26%. That's 24% based on net income. And with Caterpillar, you can see just massive earnings growth in the past couple years, and stock price has followed up to around all-time highs. And the big question with whether or not you would buy Caterpillar here is whether you think earnings will come back down anytime soon, or if you think that this growth will continue with infrastructure spending, etc. And that's really the game with this stock. But they do have a pretty high-quality business model where if there is a down cycle and you can get it at a cheap valuation, that might be a great time to add. Next, we have Illinois Tool Works Incorporated, ticker symbol ITW. Current dividend yield is 2.32%. Good long-term growth, 12.79% 10-year compound annual growth rate of the dividend. This has slowed down though, with 6.87% in the most recent year. Free cash flow based payout ratio is 52%. That's 54% based on net income. And the long-term growth seems to be slow and reliable, so this could be an interesting one to add. Next, we have Atmos Energy Corporation, ticker symbol ATO. Current dividend yield is 2.79%. It's a quarterly payer. 10-year compound annual growth rate of the dividend is 8%. Most recent dividend increase is 8.7%. And my concern with this stock has always been the free cash flow based payout ratio, although it's 65% in the most recent year, so it seems like free cash flow is finally turning positive. It is sustainable based on net income historically, 48% in the most recent year. But ATO has that problem with many utilities where they overspend on capital expenditures significantly. Earnings growth does seem to be accelerating though. And if we look at this, free cash flow is an outlier and it is going to continue being negative in the future. And this is similar to the problems we discussed with the other utilities. CapEx just continues to grow at an insane rate. And this is all fueled by debt pretty much. All right, next we have Federal Realty Investment Trust, ticker symbol FRT. I used to own this stock. Current dividend yields 4.27%. 10-year CAGR of the dividends 3.4%. However, growth has slowed down significantly, with the 5-year CAGR being 1.34%. The most recent increase is 0.93%. And payout ratio seems to be unsustainable based on every metric. And I sold this because of the lack of growth across the board. They own some high quality assets, I won't lie about that. But I mainly used this as a trade during 2020 during the lockdown, where I bought in these low prices and I sold around here-ish, somewhere in here. Long term though, this will not lead to high total returns in my opinion relative to other positions. All right guys, we now have Stanley Black & Decker, ticker symbol SWK. Current dividend yields 3.88%, which is high. It's a quarterly payer. 10-year CAGR of the dividends 4.94%. This has slowed down though. Most recent increase was 1.25%. They had 2 years of unsustainable free cash flow payout ratio. Most recent year is 56%. And the past 2 years have been unsustainable based on net income payout ratio. And the stock price has crashed significantly because of this dip in earnings. So with Stanley Black & Decker, it could be a good trade or even long-term buying opportunity if you think the business is going to recover to these prior levels. I have not dived into it enough myself to give you an analysis, but that is the question here. And if you are not sure, then I would definitely stay away. All right, now we have Cisco Corporation, ticker symbol SYY. And this is actually a restaurant company. They provides supplies and whatnot for restaurants and food. It's not Cisco, the server company. Current dividend yield is 2.81%. It's a quarterly payer. 10-year CAGR of the dividends, 5.81%. This is slowing down though. The most recent increase was 2%. Payout ratio based on free cash flow, 48%. And that's 56% based on net income. And this is a company that has really struggled since the pandemic. Their earnings are pretty much flat since 2020, and they had many years of a massive dip. Their stock price has recovered though since the 2020 lows. So who knows, long term it could be interesting, but I haven't done enough analysis to give you a good opinion. Next, we have International Business Machines Corporation, ticker symbol IBM. It is IBM. Current dividend yield, 3.97%, although growth is terribly slow. Most recent increase was 0.6%, and the 3-year CAGR is 2.13%, 5-year CAGR 1.52%. Payout ratio based on free cash flow is 50%, and it's an 80% one based on net income, with the 3 prior years being unsustainable. And the story with IBM is continued earnings decline, as they are no longer the tech giant they once were. They're working on it, trying to turn around. They have some interesting businesses in AI and cloud, but they're not a leader in either of those spaces, in my opinion. IBM is one I would stay away from, especially with this recent increase in prices. I don't really see it myself personally. Next, we have ExxonMobil, ticker symbol XOM. I own Exxon in my portfolio, as many of you see. It's one of my top holdings. And like Chevron, I bought it during that 2020 dip and have not been adding since, but I bought a lot of Exxon at that time. So the current dividend yield is 3.3%. Although mine is 11% from reinvesting dividends and my high yield on cost. 10-year compound annual growth rate of the dividends, 3.25%. The most recent dividend increase is 4.4%. Payout ratio based on free cash flow has been very sustainable in the past 3 years, between 25 and 45%, similar for net income. And I'm going to repeat a little bit of my same analysis from Chevron here. Oil, it's a very cyclical thing. There's boom and bust cycles, and you are either making tons of money or losing money depending on the price of oil at any time. Right now, we're still in a highly profitable range, and 2022 was one of the best oil price from a profitability standpoint in decades. So Exxon and Chevron, they were raking in cash in that time, and they use those cash flows to power their balance sheet so that they continue paying a growing dividend throughout boom and bust cycles. So would I buy Exxon right now? No, but I do plan to continue owning it. And as an investor, I don't really like adding to oil stocks unless we're in one of those bust cycles where the stock is being valued extremely poorly. All right, now we have the JM Smucker Company, ticker symbol SJM. 3.68% dividend yield, quarterly payer. 10-year CAGR is 6.22%. Most recent dividend increase is 3.92%. It is sustainable based on free cash flow. You got a 67% payout ratio. This is a high-quality consumer defensive company. I like the stock. I did own it briefly, but in my opinion, the growth rate is not high enough to make a place in my portfolio. It is interesting though, and if you want this higher dividend yield, this could be a great option, especially with the stock price declining in recent years. I do think it will have continued long-term growth. They own Uncrustables, which is awesome. And a lot of other high quality brands. They're in coffee and pet foods too. Jif peanut butter, all that stuff. All right, now we have Cardinal Health, ticker symbol CAH. 2.05% dividend yield, and the dividend growth rate is horrible. 5-year CAGR of 1%. Payout ratio is sustainable though, 22% free cash flow. Net income though, it tells a different story, so we'll have to dive into that. I can already tell you I'm just out on the stock based on slower earnings growth, slower dividend growth, and high price. All right, now we have McDonald's Corporation, ticker symbol MCD. I'm loving it. All right, so McDonald's is one of the best companies in the world. We all know it. 2.56% dividend yield, quarterly payer. 10-year CAGR of the dividends, 7.5%. Most recent increase is just under 10%. Over time, they've gone from quarterly payers to annual, back to quarterly. Payout ratio based on free cash flow is 62%. It's 53% based on net income. Extremely high quality business. Earnings growth over time has been pretty reliable. Stock price appreciation has followed that. The valuation's not crazy. I don't own it in my portfolio though, as I think there are probably higher quality growth companies for total return over like a 10, 20, 30 year period. But McDonald's is a really solid one. And if you need a good, high quality, reliable dividend stock to have in your retirement portfolio, McDonald's is a fine option. All right, then you have Brown-Forman Corporation, ticker symbol BFB. And stock price here has crashed. Earnings growth is Consistent, but slowly growing. I seem to have a bug here around the dividend. I'll look into that for you guys, get that fixed. Yeah, we definitely have a couple data errors here on this stock. I'll fix that. Most recent dividend increase was 5.83%. Payout ratio seems to be sustainable over time. Next, we have AbbVie, ticker symbol ABBV. This is the company that spun out of Abbott. It's their pharmaceutical business. Current dividend yield's 3.68%. Quarterly dividend payer. 10-year CAGR of the dividends, 13.95%, which is very high. Not going to stay at that rate. Dividend growth rate has dropped to 4.73% in the most recent year. It is sustainable, 47% based on free cash flow in the most recent payout ratio. However, net income in the most recent year was 218%. And the main concern here is the dip in earnings since 2023. Stock price is still up there, close to its all-time high. Might not be the best buying opportunity right now. Next, we have Lowe's Companies, ticker symbol LOW. And this is a historically great dividend growth stock. The current dividend yield's 2.11%. It's a quarterly payer. 10-year CAGR of the dividend is 17.46%. However, this is starting to slow down. The most recent increase was 4.55%, and prior to that, it was 4.76%. And just in 2022, we had a 31% dividend increase that year, which is crazy. So they seem to have overextended themselves a bit. And this dividend payout ratio based on free cash flow is 40% and 32% based on net income. So these are very sustainable levels, but the problems with low stock have less to do with the dividend and more to do with the rest of their business. One, earnings have declined slightly in the past year, which has hurt their long-term growth trajectory. But what's really going on is they have some unsustainable business practices, in my opinion. They are buying back stock at an incredibly high rate, which is great as a shareholder, but they're talking 7 to 9% a year in share buybacks of their shares outstanding. That's a lot of money. So this is $13 billion, $14 billion, $6 billion in share buybacks. This is well exceeding their free cash flow every single year. So we know their dividend is sustainable, but these share buybacks are not. And they've been fueling this with debt. So you can see their debt went from $16 billion in 2019 all the way to $40 billion in 2024. So that's my main concern around Lowe's stock, but still, it's an interesting one. All right, we are down to our last 6. Now we have Franklin Resources, ticker symbol BEN. Current dividend yield, 5.34%. It's a quarterly dividend payer. 10-year CAGR of the dividends, about 10%. However, this has slowed with the most recent increase being 3%. Payout ratio based on free cash flow is 61%, 68% based on net income. Earnings growth is terrible here. That's why stock price growth has been terrible. I'm staying away from this one. Next, we have Nordson Corporation, ticker symbol NDSN. 1.2% dividend yield. Growth rate has been fantastic. 14.22% 10-year compound annual growth rate. 20.36% over the past 3 years. However, this is slowing with a 4.62% in the most recent dividend increase. Payout ratio is sustainable, 24% based on free cash flow and 30% based on net income. It's always in this sustainable range. And this does seem like a high quality, low yield, high growth business. Stock price is increasing and earnings per share growth is increasing. Could be worth adding to your portfolio or watch list. Next, we have the Clorox Company, ticker symbol CLX. Current dividend yield is 3.62%. It's a quarterly payer. 10-year CAGR of the dividends, 5.39%, although this has slowed massively, with the most recent increase being 1.69% and the year prior being 1.7%. And their payout ratio got to unsustainable levels in 2022, 62% based on free cash flow in 23, but still unsustainable based on net income. And stock price has been terrible as their earnings collapsed after 2020 and the pandemic boom around their business. However, they're slowly starting to grow out of it, so we might be on the other side of that now. And if that is true, maybe this could be one of the better buying opportunities in the past 5 years or so, but I'm staying away from stocks like this. Next, we have Genuine Parts Company, ticker symbol GPC, 2.77% dividend yield, quarterly payer, 5.69% 10-year CAGR, and the most recent increase was 5.26%, 57% free cash flow based payout ratio in the most recent year. That is pretty sustainable. We got an increase in earnings per share growth since 2020, which is nice. Stock price has largely followed that trend. Second to last, the penultimate, we have Target Corporation, ticker symbol TGT. This retail giant has a 3.3% dividend yield. It's a quarterly payer. 10-year compound annual growth rate of the dividend is just under 10%, although this is slowing down massively, with the most recent increase being 1.85%. But they did have a few years of really high growth prior to that. The payout ratio is sustainable based on free cash flow at 50%. That is similar to net income. And Target, they really just had this stock price collapse since 2021. And that could be a good long-term buying opportunity. Now, it was a justifiable collapse because their earnings did fall a similar amount, and usually stock price will follow their earnings. But at this valuation, if you think Target will have good long-term growth, then this could be an interesting time to add to the stock. Last, coming up the rear, we have West Pharmaceutical Services, ticker symbol WST. Current dividend yield is 0.25%, so that is very, very low. It's a quarterly payer. 10-year dividend CAGR is 7.18%. Most recent dividend increase was 5.26%. Payout ratio is very sustainable, 13% based on free cash flow. 9% based on net income. It stays in that range. You really had this big earnings run up here until 2021, and stock price followed that pretty closely. And then it seems like earnings have been falling off since then, and stock price has fallen off since then as well. Not interested in this one. Bad way to end it. So those are the Dividend Aristocrat stocks as of 2024. If you liked the video, subscribe. There will be more every week, new videos every Friday. And if you found this stock research tool to be useful or interesting and you want to try it out, please sign up at dividenddata.com. We have a summer sale going on. 50% off both the monthly and annual plan. Enter the promo code SUMMER at checkout. I'll show it on the screen how to do it. You'll get 50% off and you get to lock in that low price for life. This is available for a limited time, so please sign up now. The first 100 people to join the annual plan, of which there's still some availability, you will get entered into a giveaway to get different merch items from dividenddata.com. That could be this Buffett Munger 24 sweatshirt, Make Dividends Great Again hats, etc. All these different options. I'll make more merch too in the future. It's kind of fun. So thank you guys for watching, and I'll see you in the next episode.